I learned early that the market rarely hurts a man all at once. It lulls him first. It lets him feel clever. It allows him to believe he has finally found his stride, and that is when the danger quietly takes a seat beside him. If you watched the previous video on when almost becomes always, you already know how repetition can dull a trader's senses, and today's idea grows right out of that same soil. A series of modest gains doesn't feel like risk at all. It feels like progress. A little here, a little there. No fireworks, no panic. Just steady green numbers blinking back at you. And tell me, have you ever noticed how calm success can be when it's small enough not to scare you? That calm is precisely what changes a man's risk tolerance without him ever voting on it. You don't wake up one morning and decide to trade bigger because you're reckless. You trade bigger because nothing bad happened yesterday or the day before. The market paid you on time, like a polite debtor, and after a while, you begin to assume it always will. I've seen men go broke who never once felt greedy. That surprises people. They imagine ruin comes from wild bets and fevered dreams, but more often, it comes from comfort. The charts behave. Your entries aren't sloppy. Pullbacks respect your lines. Breakouts follow through just enough to reward you. And you think, why not lean a little more into this? Isn't that how confidence is supposed to work? But the market does not measure confidence the way men do. It measures exposure. Each modest gain nudges your sense of normal. Yesterday's position size feels small today. Last week's risk feels conservative now. You haven't crossed a line in your mind because the line moved quietly while you weren't looking. And the danger isn't the larger position itself. The danger is that your tolerance for discomfort has expanded faster than your understanding of the risk. Look at a chart long enough, and it will teach you this lesson if you're willing to listen. Trends don't end with a bang. They end with subtle changes. The pullbacks get shallower. The volume thins. The reaction slow. Nothing dramatic. Nothing that screams at you. And isn't that exactly how your risk behavior changes too? You tell yourself you're trading the same setup, same pattern, same rules. But the dollars at stake are different now. The emotional weight is heavier, even if you don't feel it yet. And when a man says he doesn't feel it, that's usually because the market hasn't tested him lately. Have you ever noticed how a losing trade after a long winning streak feels insulting? Not painful at first, but offensive. As if the market has broken an unspoken agreement. That reaction is a clue. It tells you that somewhere along the way, you stopped seeing risk as a constant companion and started seeing it as an occasional visitor. The old tape readers understood this, even if they couldn't explain it the way we do now. They knew that danger crept in during the quiet times. After a string of small wins, the hand reaches for more shares without a second thought. Stops widen just a touch. Exits get delayed because who'll come back? And why wouldn't it? It always has, hasn't it? This is where oversized positions get normalized. Not because they're logical, but because they feel familiar. Familiarity is seductive in trading. It whispers that you've earned this comfort, that your judgment has improved, that the market has finally recognized you. But the market doesn't recognize anyone. It only responds. There's a point on every chart where strength turns into vulnerability, and it rarely announces itself. In the same way, there's a point in every trader's growth where confidence turns into fragility. The account looks healthy. The equity curve slopes upward. But the margin for error has quietly shrunk. Think about this: if one ordinary loss can now erase several days or weeks of work, are you really safer than before? Or have you simply traded consistency for exposure? Most traders don't ask that question until the answer is forced on them. The wealth mindset in trading isn't about pressing harder when things go well. It's about respecting the math even when your emotions feel justified. Small gains feel earned. Big positions feel deserved. But the market doesn't pay based on feelings. It pays based on alignment with risk and timing. This ties back to that earlier discussion about how almost turns into always without resistance. Back then, it was about behavior repeating until it felt permanent. Here, it's about success repeating until risk feels irrelevant. The mechanism is the same. Repetition dulls awareness. A disciplined trader treats risk like gravity. You don't curse it when you fall. You don't celebrate when it doesn't pull you down. You account for it at all times. But when modest gains stack up, gravity feels lighter. You jump higher, you land harder, and eventually the ground reminds you it was always there. Charts don't punish optimism, they punish imbalance. If your position size has grown faster than your ability to absorb a loss, you've entered fragile territory whether you admit it or not. Fragility doesn't announce itself with fear. It announces itself with ease. And that's the most dangerous part. Ease convinces you that you've evolved beyond caution, that your read is sharper now, that your touch is better. But skill doesn't remove risk, it only manages it. When management slips, even slightly, the account becomes a glass structure, strong-looking, profitable, and one surprise away from cracking. I've always believed that the market teaches the same lesson over and over, just at different price levels. A man who survives learns to hear the lesson earlier next time. When your gains are modest and steady, that's when you must listen closest. That's when you must ask yourself uncomfortable questions. Not later, not after the drawdown, because the market doesn't collapse accounts in one dramatic stroke. It waits until the trader is comfortable enough to hold more than he should, calm enough to ignore warning signs, and confident enough to believe that today will behave like yesterday, and tomorrow will do the same, and that the fragile structure he's standing on is solid simply because it hasn't yet been tested hard enough to show where the cracks already are. Modest wins have a quiet way of changing a man's definition of risk without ever asking his permission. That's the part most traders miss. They think risk tolerance is something you decide in advance, like position size written in a rule book. But the market doesn't work that way, and neither does the human mind. Risk tolerance is trained, day by day, trade by trade, especially when the market keeps paying you without protest. A small win doesn't ring any alarms. It doesn't demand reflection. It doesn't make you sit back and review your behavior. It just feels right. And when that feeling repeats often enough, your sense of what is acceptable begins to drift. Not sharply, not dramatically. Just enough that yesterday's caution feels unnecessary today. Have you ever noticed that you don't celebrate modest gains, but you also don't question them? That's how normal gets rewritten. When you first start trading, every position feels heavy. You notice every tick. You know exactly where your stop is because the loss matters. Then a stretch of steady gains comes along. Nothing spectacular, just competence rewarded. Your charts behave. Your entries work often enough. Losses are shallow and quickly recovered. And slowly, without any meeting in your head, your perception of danger changes. You don't say, I'm willing to risk more now. You say, this is working. And those two thoughts are not the same, even though they lead to the same behavior. The market encourages this shift because it doesn't correct you immediately. If it did, fewer traders would ever get into trouble. But modest wins are like a calm sea. You loosen your grip on the wheel because nothing is rocking the boat. You assume stability is the environment, not the condition. And that assumption is where the trouble starts. Charts play along beautifully during this phase. Trends look clean. Pullbacks are orderly. Breakouts follow through just enough to reinforce your confidence. You begin to trust not just the setup, but yourself inside the setup. And confidence, when it's fed by repetition, starts to feel like certainty. Isn't that when a trader is most vulnerable? Your position size creeps up almost accidentally. Maybe you add a few more shares because the stop still looks reasonable. Maybe you increase size because volatility seems lower. Or maybe you don't increase size at all. You just stop noticing how large it has already become relative to your account. The math didn't change, but your sensitivity to it did. That's what it means when modest gains reset normal risk. The numbers on the screen haven't hypnotized you, familiarity has. You've seen this movie before, and it ended well. So your mind edits out the possibility of a different ending. But the market never promised consistency. It only delivered it for a while. A trader with a healthy mindset doesn't ask, how much can I make? He asks, how much damage can I take if I'm wrong? and that question feels less urgent after a string of wins. Losses feel theoretical then. They belong to other people, or to earlier versions of yourself who didn't know what you know now. That's the illusion. Knowledge didn't remove risk. It just made the risk feel deserved. When modest wins pile up, discipline stops feeling like protection and starts feeling like restraint. You begin to think in terms of efficiency. Why not press a little harder? Why not make the market work for you while it's in a cooperative mood? After all, aren't you trading the same patterns, reading the same price action, respecting the same levels? But here's the quiet truth: the setup didn't change, but the consequences did. Risk is not just about where you enter or exit. It's about how much psychological and financial pressure you've layered onto a single idea. When modest wins normalize higher exposure, one ordinary mistake carries more weight than it used to, and the market doesn't adjust its behavior to match your new tolerance. That's why experienced traders grow suspicious during easy periods. They know that comfort is not confirmation. They know that a run of small gains can be more dangerous than a sharp drawdown because it reshapes habits instead of correcting them. Pain forces review. Comfort encourages continuation. Ask yourself this honestly: if your next losing trade is perfectly normal by your rules, but unusually painful by your account size, what changed? The market didn't. Your definition of acceptable did. Wealth in trading isn't built by ignoring risk during good times. It's built by treating good times as temporary conditions, not permanent upgrades. The trader who lasts doesn't let modest success renegotiate the rules behind his back. He revisits them deliberately, especially when everything feels easy, because the market's most effective lesson is never delivered during chaos. It's delivered during calm, when nothing seems urgent, when positions feel manageable, when gains feel routine, and when risk quietly stops feeling like risk at all, and instead starts feeling like background noise you no longer bother to listen to as closely as you once did when every trade mattered enough to keep you alert, cautious, and aware of how thin the line really is between controlled exposure and the kind of confidence that slowly convinces you that what you're doing is safe simply because it has been working long enough for you to forget that all the market is not a fixed condition, but a temporary agreement that can change without warning, without drama, and without regard for how comfortable you've become operating inside it. Consistency in profits has a way of convincing a trader that he has solved something permanent, when in reality he has only aligned with a temporary condition. That misunderstanding is subtle, but it's costly. When profits come in regularly, even if they're small, the mind begins to assume durability where there is only rhythm. The chart looks orderly, the account grows steadily, and the trader stops measuring risk in terms of consequence and starts measuring it in terms of probability. And probability feels friendly when it keeps agreeing with you. The problem isn't that the trader ignores risk, it's that he redefines it. A setup that works 8 times out of 10 starts to feel safe, even if the 2 times it fails now carry more weight than before. Consistency dulls the urgency to ask what happens when the pattern breaks, because the pattern hasn't broken in a while. Have you noticed how silence from the market can feel like approval? On the chart, shrinking margins for error don't announce themselves. They hide inside success. Pullbacks that once offered wide exits become tighter. Entries that once allowed room now demand precision. Volatility contracts just enough to make stop placement feel efficient rather than fragile. And because trades keep working, the trader adapts without resistance. He doesn't see that the space between right and wrong is narrowing. When an equity curve climbs smoothly, it tells a story that feels reassuring. It suggests balance. It suggests control. But smooth curves often come from environments where the market is forgiving. And forgiving markets allow mistakes to survive longer than they should. They allow late entries to recover. They allow poor exits to be masked by continuation. Over time, this teaches the trader the wrong lesson. Instead of learning accuracy, he learns tolerance. The chart doesn't show you margin for error directly. It shows you outcomes. And outcomes can be deceptive when conditions are friendly. A trader might think his read is improving, when in fact the market is simply offering fewer punishments for imprecision. That's when position size grows without a corresponding increase in skill. The risk doesn't disappear, it concentrates. Consistency creates a rhythm, and rhythm creates expectation. You begin to assume that tomorrow will resemble today closely enough to justify the same behavior. Stops feel like formalities. Drawdowns feel unlikely, and because losses are rare when they do occur, they arrive heavier than expected. That weight comes from the shrinking margin that was never acknowledged. Think about how a trend matures. Early on, it forgives sloppy timing. Later, it demands exactness. The trader who doesn't adjust believes he's trading the same market, but he's not. The character has changed, and when margins shrink, size becomes the enemy. A small mistake in a wide environment is education. The same mistake in a tight environment is damage. Consistent profits can trick a trader into thinking his edge has widened, when in fact the market's tolerance has narrowed. The edge feels stable because it hasn't been challenged, but edges are not proven by repetition alone. They're proven by survival under stress, and stress is absent during smooth periods. That's why experienced traders become cautious when everything feels easy. They understand that ease is often borrowed from the future. When margins shrink, one unplanned event, one failed breakout, one sudden expansion in volatility can do more harm than a dozen clean wins can repair. Have you ever noticed how the most painful losses come after periods where you felt most in control? Wealth in trading is built by respecting asymmetry. When margins for error are wide, opportunity can be pressed. When they narrow, protection must take precedence. Consistency in profits tempts a trader to forget this balance. He begins to think in terms of average outcomes instead of worst cases. But the account is not affected by averages, it's affected by extremes. On the chart, a narrowing margin often shows up as compression. Price coils, ranges tighten. Breakouts look clean but carry less follow-through. Volume thins, and because nothing dramatic happens, the trader assumes nothing important is happening. Yet this is where risk concentrates. Consistency masks vulnerability because it creates familiarity. Familiarity breeds trust, and trust, when not re-examined, becomes assumption. The trader assumes he has room because he's had room. He assumes he has time because he's had time. He assumes the market will give him a second chance because it always has. But markets don't give second chances. They only give outcomes. The mindset that builds wealth is not impressed by smooth curves or frequent wins. It is impressed by resilience. It asks how much strain the strategy can endure before it breaks. It asks how much room exists when the unexpected arrives. And during periods of consistency, those questions feel unnecessary, even pessimistic. That's the trap. Margins for error shrink quietly because success encourages repetition without scrutiny. The trader repeats what works, but doesn't test what happens when it stops working. He confuses consistency with robustness. He confuses a calm market with a safe one. And by the time volatility expands or direction fails, the room he thought he had is already gone. Charts don't warn you with words. They warn you with behavior. When price becomes less forgiving, when reactions become sharper, when continuation becomes conditional, the margin is shrinking. The trader who keeps trading as if nothing has changed is not being bold, he's being blind. Consistency should be a signal to reassess, not to relax. It should prompt questions about exposure, size, and dependency on conditions. But the human mind prefers to ride what feels good. It prefers validation over vigilance. And that's how shrinking margins stay invisible. Not because the trader lacks intelligence, but because success has softened his attention, convinced him that precision is optional, and allowed him to operate closer and closer to the edge without realizing that the distance between skill and survival has narrowed to the point where one ordinary mistake, one normal loss, one moment of hesitation carries consequences that no longer match the calm story the equity curve has been telling up to that point. Position size rarely grows because a trader suddenly understands the market better. More often, it grows because the trader has grown comfortable inside it. Comfort is not the same thing as clarity, but the two feel similar when the tape has been friendly. When trades work often enough, the mind begins to confuse familiarity with insight, And that confusion quietly reshapes how much exposure feels reasonable. A trader doesn't wake up deciding to bet bigger because he's careless. He does it because nothing has gone wrong in a while. The last few trades behaved. The stops held. The recoveries came quickly. And each time the market forgave a small mistake, it trained the trader to believe that mistakes aren't as dangerous as they once seemed. Have you noticed how quickly danger loses its edge when it stops hurting? Charts reinforce this comfort by staying predictable just long enough to make increased size feel logical. The same breakout that once required caution now feels routine. The same pullback that once demanded patience now feels like an opportunity to press harder. The setup didn't improve, but the trader's emotional relationship to it did. Comfort speaks in quiet phrases. I've seen this before. This market respects levels. This one usually works. Those thoughts don't sound reckless. They sound experienced. And that's why they're dangerous. Experience should lead to precision, not to heavier exposure without stricter standards. But comfort lowers standards by making them feel unnecessary. When position size grows from comfort, risk is no longer evaluated fresh each trade. It's inherited from the last success. The trader assumes that today's conditions match yesterday's closely enough to justify the same or larger commitment. He doesn't ask what has changed because nothing obvious has failed. And markets rarely announce change until after the fact. The wealth building mindset in trading isn't about pressing size when things feel easy. It's about pressing size only when structure supports it. Comfort ignores structure. It focuses on outcome history rather than current context. That's why traders who size up from comfort often struggle to explain their reasoning beyond. It's been working. On the chart, comfort shows up when reactions no longer surprise you, when volatility feels tame, when price respects lines just often enough to make you trust them. And trust, once established, invites larger bets. But the market doesn't reward trust, it rewards alignment. Alignment requires constant verification. Comfort replaces verification with assumption. Think about how quickly a trader adapts to new size. The first larger position feels heavy. The second feels manageable. The third feels normal. At no point does the trader stop and say, "This is now risky," because risk didn't spike suddenly. It crept, and creeping risk is the hardest to detect. Position size grown from clarity is supported by tighter execution, quicker exits, and stricter discipline. Position size grown from comfort is supported by hope that conditions remain unchanged. That difference only reveals itself when something goes wrong. Have you ever noticed that when a large position moves against you, your analysis suddenly becomes more flexible? Levels become zones. Stops become guidelines. Timeframes expand. That's not analysis improving, that's comfort resisting loss. Comfort-based sizing also shifts the trader's focus. Instead of reading the chart objectively, he begins to monitor his P&L emotionally. Small fluctuations feel louder, decisions feel heavier, and ironically, the trader who sized up to feel more confident now feels more fragile. The market doesn't punish size. It punishes mismatched size. A large position in a forgiving environment can survive poor execution. The same position in a changing environment cannot. Comfort blinds the trader to the shift because comfort was built during a different phase. This is why seasoned operators reduce size when things feel too easy. They know that ease often precedes transition. They know that markets change character without notice. And they know that comfort is a trailing indicator, not a leading one. Wealth grows when exposure is intentional. It decays when exposure is habitual. Comfort creates habits. Clarity demands effort. The trader who sizes up from comfort believes he is being efficient. In reality, he is becoming dependent on the market, behaving the same way it has recently. Charts don't reward dependency. They reward responsiveness. A position sized from clarity can be defended with logic. A position sized from comfort is defended with past outcomes, and past outcomes have no obligation to repeat. When the market shifts, the trader who relied on comfort finds himself explaining why a normal trade now feels unmanageable. Comfort also shortens patience. When larger size becomes normal, the trader expects quicker validation. He watches ticks instead of structure. He reacts instead of observes. The chart hasn't changed, but his relationship to it has. He is no longer reading price, he is negotiating with it. Have you ever caught yourself thinking, it shouldn't be doing this? Instead of asking, what is it doing? The thought comes from comfort being challenged. Position size should be an expression of understanding, not a reward for recent success. When it becomes a reward, it carries emotional weight that distorts judgment. The trader isn't just managing risk anymore, he's defending identity. He believes he deserves this size because he's been right. Markets don't care about deserving. They care about alignment in the moment. Comfort tells you that you've earned the right to risk more. Clarity tells you whether the environment can absorb that risk. When the two are confused, position size becomes a liability dressed up as confidence. The most dangerous trades are not the impulsive ones taken in excitement. They are the calm ones taken in familiarity. They feel routine. They feel justified. And they carry exposure that was never consciously chosen, only gradually accepted through repetition, through smooth outcomes, and through the quiet belief that because nothing bad has happened recently, nothing bad is likely to happen now, even as the conditions that made that comfort possible have already begun to shift beneath the surface of the chart, tightening the space between right and wrong, without giving any notice to the trader, who is still operating on yesterday's sense of safety. A familiar setup can be one of the most dangerous things a trader encounters, not because it stops working, but because it invites larger commitment without demanding deeper thought. When you've seen the same pattern play out again and again, your guard drops. The chart feels readable. The behavior feels predictable. And predictability encourages you to attach more capital to the idea without re-examining whether the environment still supports the decision. The setup hasn't changed in your mind, so you assume the risk hasn't changed either. But risk isn't defined by the shape of the pattern alone. It's defined by context, volatility, liquidity, and how much money you've tied to the outcome. When the dollars behind a familiar setup quietly multiply, the setup itself becomes something else entirely, even though it looks identical on the chart. Familiarity reduces friction. You don't hesitate. You don't question the entry as much. You don't study the broader market because you know this pattern. That ease feels like skill. It feels earned. Have you ever noticed how quickly a familiar trade bypasses your internal checklist? That's where danger slips in. The checklist isn't skipped because the trader is lazy. It's skipped because the trader is comfortable. Comfort assumes confirmation. It assumes that because the pattern worked before, it deserves trust now. And trust, once given, allows size to expand. Charts don't care how often you've seen a setup. They care about order flow in the present moment. A pattern that worked beautifully with small size can become destructive when the position is oversized. Not because the pattern failed, but because the tolerance for noise vanished. Every tick now matters. Every pause feels threatening. When the dollars multiply, the trader's behavior changes even if he doesn't admit it. Stops become suggestions. Targets become hopes. Time frames stretch to justify holding. The familiar setup is no longer being traded, it's being defended. This is where many traders get confused. They think the setup stopped working. In reality, the setup worked the same way it always did. What changed was the trader's ability to endure its normal fluctuations. The pattern didn't break. The risk structure did. Familiar setups invite mental shortcuts. You stop analyzing and start recalling. You trade memory instead of price, and memory is selective. It remembers the wins more clearly than the losses. It smooths over drawdowns and highlights follow through. That selective recall makes larger size feel reasonable. Have you ever caught yourself saying, "This one usually bounces here," instead of waiting to see if it actually does? That phrase is a warning sign. It means the setup has shifted from observation to expectation, and expectation, when paired with increased dollars, creates fragility. The trader is no longer reacting to information. He's waiting for confirmation of a belief. Oversized positions turn familiar patterns into emotional experiences. The trader is no longer watching structure unfold. He's watching his account fluctuate. The chart becomes secondary to the P&L, and when that happens, execution suffers. The market doesn't punish familiarity. It punishes complacency, and complacency grows fastest in environments where patterns repeat often enough to feel dependable. The trader begins to assume that repetition equals reliability, but repetition without stress testing doesn't prove strength. It only proves that conditions have been kind. Wealth is built by understanding that every trade is unique, even when it looks the same. The candle structure may repeat, but the participants change. The volume changes. The broader context changes. And when size increases, those differences matter more. A small position allows room for interpretation. A large position demands certainty, but markets rarely offer certainty. When traders oversize familiar setups, they are demanding more from the market than it can reliably give. Charts always move in ranges of probability, not promises. A familiar setup might offer a statistical edge, but it does not guarantee smooth execution. When size is modest, the edge can express itself over time. When size is oversized, one deviation can overwhelm that edge.